Hey everyone, it's Tom Karadza from Rockstar Real Estate, and this is a follow-up to the video that we did on inflation and deflation. We had a bunch of questions on the indicators that we look at, and we love getting those questions because listen, when we quit our jobs to go out on our own in the real estate world and the entrepreneurial world, no one really gave us a guide around the big macroeconomic indicators to look at, and we had to do our own research on that. And I'm sure you're in the same boat. Like, we all see headlines on stuff, but the headlines really don't add up. And even if you listen to some of the bank economists, you get bits and pieces of information, but it's hard to build your own framework on how to analyze the economy. So over the last decade, we've read books. I can't even tell you how many books and how much research we put into this. And I've just shared some of the indicators that we look at here for you, just to give you an idea of some of the things we're looking at, because perhaps you might want to start looking at this information, or it might leapfrog you into going on a deep dive down into this information. So we also put a little worksheet together for you. This is the rough copy of it. It's all marked up. We're still tweaking it. But in the description of this video, we're going to have a link where you can get this worksheet if you'd like it. So I'll just walk you through some of the indicators that we're looking at. So here's how we generally do it, a little bit of a framework anyway. The top indicators are listed here. Here's our top 10 right now. And the top 5 that we're looking at right here above this dotted line, these are what we would consider our primary indicators for looking at the economy right now. And if we list through them, the top one is velocity of money. And you hear economists talk about the velocity of money sometimes, and they'll allude to it. But from our research, it's a hugely important indicator because it tells us if people are spending money or if they're sitting on their hands and the money's not going anywhere. And in times like this, we really are curious as to whether people are spending money or if they're just saving it, paying off debt, or just keeping it under their mattresses at home. So velocity of money is a really important indicator. And on the worksheet that you can get, I'll put a little description of what you can Google up. Maybe I'll put it as a link, I'm not sure yet. But if you just Google up the St. Louis Federal Reserve velocity of money, even as Canadians, it's very insightful for us to see that US data, because what's happening in the US is often a really good indicator of how we are behaving here in this country. So St. Louis Federal Reserve velocity of money is where you can see that chart. And I'll explain this in a second. I'll just go through the other indicators. Then there's interest rates. It might sound obvious, but really what we're trying to look at are real rates. So real rates are whatever the Bank of Canada overnight rate might be right now, minus inflation. Okay, and that'll give you the real rate. So as by way of a easy example, if rates from the Bank of Canada are 10%, and inflation is 5%, then 10 minus 5 gives you a real rate of 5%. In this world, it's really complicated right now because rates are so low, and then if inflation starts to dip negative in the next few months, then when you subtract a negative number, you're actually going to add, and rates can be positive. So it's a really weird situation where we're in. Sorry, I can't speak. Real rates might actually be going positive even while mortgages that we can get and that kind of thing are really at historic lows or really low. So real rates might actually be positive territory. And that's something we pay a lot of attention to, because in a time when you want people to spend money or not, we don't even care if people spend money or don't spend money, but I'm sure the central banks want people to spend money to increase the velocity of money. If real rates increase, that is not good for the central banks and the behavior that they're trying to encourage. So that's an indicator that we look at. Then there's debt levels. And here I just wrote up debt levels as one line item, but on the worksheet that we have for you, we'll share, or we'll just break it down to government, corporate, and individual. We could also separate out the business or corporate one into financial service companies and non-financial, but we just left it corporate. And the reason that we want to break it out in 3 like that is because although debt levels have been fairly high, there's some areas that weren't as high 10 years ago, like the corporate debt levels, that have really skyrocketed over the last decade. So we kind of broke those out as 3 independent little indicators for us. The next one is employment, I think self-explanatory. The next one is lending standards. Are the banks going to tighten lending or loosen lending? What we're seeing on the streets right now is the banks in Canada are clearly tightening their lending standards. So this is something we're paying attention to. So that makes up the top 5. And then there's these other ones that are really important to us as well, and they are population growth, especially for real estate in the Greater Toronto. In Canada it applies, in the Greater Toronto area it applies, Southern Ontario, this is a really important thing, obviously. Housing supply. So if there is population growth or lack of growth, whatever it may be, what does the housing supply look like? What's going on with fiscal stimulus? Is the government kind of doing, stimulative projects in Canada? I remember driving down one of the highways here in Ontario, probably after the 2008, 2009 US financial recession, and there was signs on the side of the highway that, this is a government project and it's your stimulus dollars at work and that kind of thing. So we want to kind of watch that. Monetary stimulus. So what's the Bank of Canada doing? What's the Federal Reserve doing? What are central banks around the world doing? And finally, the personal savings rate. And right now we have this as one of our top indicators because we want to see if the saving rate starts shooting up. Because if it starts shooting up, that's another indicator to us that people are not spending money, and it's going to be harder to get this velocity of money turning. So right now, we expect the headlines over the next few months to show that personal savings rate is going to shoot up. And the Toronto Star, the Globe and Mail, the Financial Post, will see like Canadian savings rate is increasing. That's what we anticipate to see. Time will tell, and it's something we're obviously watching. So these are some of the primary indicators we're looking at. And this is more for like the entire economy. And they'll always change slightly. There's a couple things I don't have in here that could be really good indicators, like the bond market. So you could change this to however you want. We're just trying to show some of the indicators that we look at and monitor to guide some of our own thinking and some of our own conclusions. And if you're going to do these indicators for different things, so for example, if you're looking at the real estate market specifically, you might want to take employment, lending standards, population growth, and housing supply, and maybe debt levels, and these would be your top ones, right? If you're just going to look at real estate perhaps. So you can kind of mix and match this a little bit. But right now, for everything that's going on in these times, these are our personal top ones. I labeled them out as primary. And here's kind of how we look at it. We will have different time frames over here. And so this time frame is the last decade, right? 2010 to 2020. And we will write out where we think these indicators, if for example, if the velocity of money was increasing or decreasing, we'll write out little arrows to give us an indicator of what's happening with that particular stat there. And then what we've mapped out going forward for ourselves, and obviously you can do this, and on our little worksheet that you can download, we made three little time frames here that you can map out different time frames so you can do your own analysis. But this is how we look at it. So the last decade, and then we're doing the next 6 to 12 months. And the reason we're taking such a short time frame is because we believe the next 6 or 12 months are really important. There's a lot of changes happening. It's really important to watch what's going on right at times of change like this. And then finally, the next decade, what does that look like? So, and the reason we're looking at this is we're trying to figure out, does deflation come in? How long does deflation here for? Does inflation return? When does inflation come in? And then we've written down our indicators. And once you write out your indicators, what we do is if there's a big change in the indicator, we just circle it. So when you see a lot of changes from one time period to another time period, obviously there's a big change in the economic environment. And then we'll make our investing decisions accordingly. So, and on the little worksheet, we'll have like a little guide down here about inflation and deflation and that kind of stuff. But that's how we look at these different indicators. And obviously everyone's going to have their own answer, their own opinions on some of these things. Some of these things are not completely obvious. Remember, real rates are a little different. You have to subtract inflation from rates to get the real rate. So there's different things when you might look at some of these indicators, and if you hear people talk about real rates and how, in fact, they might be going up over the next 6 months, and we're all confused by that because rates are going down and the Bank of Canada has been cutting rates. So these are kinds of things that I think is very valuable to dive into. And when you have your indicators and you look at them over time periods, you can kind of make some conclusions on what you want to do for your own family and your own life to be able to live life on your terms. We believe it's important to do this for yourself and understand as much of this as you possibly can. So we'll put this worksheet as a link below in this video in the description for you so that you can grab a copy of this thing if you want to print it off and play around with this stuff. And then, you can change it up, change your indicators to what you see fit. This is just stuff that we like watching right now. And in the next 6 months, one of the primary indicators might change a little bit. Some of the details around this might change. It's kind of an evolving thing, but this is what we do for ourselves. So hopefully you find that useful. Until next time, your life, your terms.